Hello and welcome back to another fascinating example of compound interest. For those of you that watched my last video or are familiar with the concept of compound interest, it's essentially how a number can grow exponentially over time, over multiple periods of small percentage growth. In my last video, we kind of just demonstrated the concept with $1,000 growing by 5%. We ended that experiment over 25 years. Our $1,000 grew into $3,386.35. Now, we didn't have to use dollars here, and we didn't have to use years as the interest periods. But it's commonly used for things like investing and finance. So those are the units we used. And we're going to kind of continue on that theme for this video here, because we're still going to start with $1,000, but instead of the 5%, we're going to grow by 7.33%. Now, you might be asking yourself, why 7.33%? Did he pull that number out of his rump? No, I didn't. I was very particular about this number because 7.33 has been the average annual S&P 500 return in the last 25 years. So basically, we're going to use that data from the past 25 years of S&P growth, and we're going to see if that number continued for the next 25 years, what would our investment turn into if we invested in the S&P? Now, granted, past performance in the market does not indicate future returns, but we're going to assume in this case that the S&P acts exactly the same in the next 25 years as it did in the past 25 years. And we're kind of cherry picking this number here, but as you see, we're actually cherry picking the lowest number from the chart. We could have picked the 30-year return, which is actually a lot higher, or some of the shorter returns, which are a little bit higher as well. So it's kind of interesting in itself that the S&P performed better over the last 30 years than did in the last 25 years, which kind of indicates that the last 25 years uh, were an anomaly of some kind with multiple crashes, but still a decent return there of 7.33%. So just as a reminder, before we get into this, with the 5%, we ended with 3,386. So we over tripled, and we're going to see what the difference is with just 2.33% difference. So we're going to start the experiment here. So we invested $1,000 in the S&P 500. Let's just say we did it back in 2000, the year 2000. Let's make this we time traveled, right? And obviously, as a quick basic, this isn't about the stock market, but even though it's averaged 7.33% over the last 25 years, that doesn't mean it gets 7.33% every year. It goes up, it goes down, might go up 20%, might go down 40% the next year. That's just an average annual return. But for this experiment, we're just doing straight 7.33% every single year of growth. So to calculate that first year there, we're going to take our initial investment and we're going to add that to that initial investment times our interest, which would be that 7.33%. And I'm typing my fancy dollar signs just for my equations to lock in that interest rate for my equation. We're going to end the first year with $1,073.30, which obviously is interest of $73.30. Our interest on the interest, or the compounding interest that we're getting, is zero, and that's just because we didn't get any interest. We didn't start with any interest, so we're not gaining any interest on that interest quite yet. As you'll see in the next few years, that will change fairly quickly. Moving on to year two, now we are essentially gaining 7.33% interest on our $1,073.30. That grows to $1,151.97, which means that we gained interest of $78.67 there over a $5 difference in the interest we gained that year in just 1 year. And to show you that math a little bit, so basically the difference in the compounding of the interest would be that $73.30 times our interest rate. Again, we're going to use our fancy dollar signs to lock in the equation there. And that's a compounding interest of $5.37. So it's 7.33% of our $73, how much that grew. You could also calculate it by just subtracting the difference of your latest interest amount from your original interest amount, which would always be, for this experiment, $73.30. So our compounding has started in year two. And as you'll see, this will be the driving force in the future here. Moving on to year three, just to see one more full year of this before we start jumping around a little bit. Year three, we grow to $1,236.41. We're in the 80s for the interest that we earned that year, and we got $5.77 in compounding interest, which is actually not correct. That would be the amount from this previous year. We actually want to calculate the cumulative compounding interest here. So I apologize for that. So what we're going to do, we're going to use the sum equation. So we're going to take the sum of both of the years previous, and we're going to multiply that by our interest rate. We're going to use our fancy dollar signs. I was confused why that number was so low because it actually is $11.14. And I explained this in the last video, but the reason why this number is so exciting to me, not just for the fact of how fast you will see it grow here, but this is essentially, and not essentially, it is interest gained from money that you did not earn. Because with your initial investment of $1,000, in this example, it is your hard-earned cash. You earned $1,000 with your hands, with your sweat and tears. You put it into this S&P investment account, and it gave you $73 as payment for investing in it. It's kind of how I see it. This number, however, in that second year, that $5 wasn't gained from your $1,000. It was gained from the money that you were given for that $1,000. So it's even a step further removed from you and just goes to show like at a certain point, your money will be working harder than even you can, or even that you did initially, which is extraordinarily exciting and is really the power of compounding interest. At this point, at year three, you can't really see that yet just because it's $11.14. And you're going to say to yourself, but my number was $73. So we're a seventh of that away, but it'll quickly be overtaken, and the majority of this interest number will become the interest is gaining upon itself there. So we're going to jump ahead here 2 years to year five as our first kind of milestone year. And we're going to end year five at $1,424.31. That year, we gained just under $100 in interest, $97.27 in interest. And our cumulative compounding interest here is starting to grow. This year, $23.97 of our interest was purely from the interest itself. So we're getting to the point where it's about a fifth, almost a fourth of our total interest is purely from interest itself. Does that make sense? It does in compound interest terms. It's very, very exciting. Already from year two to year five, the compound interest amount had increased by over four, which is very exciting. And what is also exciting is to take a peek at our total percent return on our investment here. So we invested in the S&P, we got that 7.33% return. What percentage return does that make in general? You might think it's 7.33%. You would be wrong in that. It'd be 42.43%. That's even more than 7.33 times 5, folks, because of the compounding nature of this money. So you gained a 42% return just by holding on to this investment for 5 years. And just to reiterate, This is not like investment advice because the rate of returns for the S&P are not linear. In theory, these first 5 years could have been down years for you. So your number might look completely different in practice. You're just hoping that the annualized rate over a longer period of time will be close to this number, or potentially, like we said in the 30-year return here, even higher. And obviously, you can't predict future returns, but based on the past, it seems fairly likely that it'll be at least this, unless things go horribly wrong. But we're going to move on from there, jump into our next milestone. We're going to jump 5 more years into the future and really see this snowball start to pick up some momentum. After 10 years, we have over doubled our initial investment, gotten $2,028.67. We gained $138.55 in interest that year. The compounding nature is almost half. $65.25. Let's just calculate that percentage return real fast. It will be over 100% because we have doubled. 102.87%. How fascinating. If we refer back to our earlier example, if you saw that video, you saw it live. If you didn't see it, you're going to see just the difference between this rate of return and the 5%. We didn't double for the 5% return until year 15. So with just a 2.33% difference in rate of return, we chopped off 5 years off of that doubling time, which goes to show just even though we're talking about very small numbers here, very small percentages, they all matter. They all make a huge difference. You might, if you had a really good high yield savings account, you might be able to get 5%. But if you want that or you want higher than that, you probably have to be invested into the stock market as the safest bet, unless you got some crazy investment opportunity that guarantees you 7.33%. The S&P is probably your best bet in that regard, just investing into an index fund of some kind to get a return rate of return similar to 7.33, but just that 2.33% makes a huge difference in terms of our doubling time. And because we're 5 years ahead, we're going to see this year 25 number as a drastically different number than our 5% example here. And we're going to go ahead and jump 10 years into the future, and we're going to jump to year 20. At year 20, we're going to see another doubling, a doubling of our doubling, which is fantastic, of course. And we're going to end with $4,115.50 at the end of year 20 of a 7.33% annual return. That is an interest gain that year of $281.06. Let's not forget, we started with $73, so almost a 4x growth on how much interest we're getting per year. And that's because of the compounding interest. The compounding interest has grown to $207.76. It is doing the heavy, heavy lifting in this growth at this point. And let's just look back 10 years ago in this example, we were under your initial. We were under 50% of that total interest. We were at 65. And in just 10 years, we were over $207.76. That's 20% of the initial money we put in. 20% of that is getting gained every year just by the interest gained on our interest. And just for example's sake, we're going to pull up this percentage just so you can try and really take in how big these numbers are growing. After 20 years, you have a rate of return of I turned it into a dollar, 311%. 311.55%, which if we take back at our previous example, we ended 25 years at 5% at 238. So we already far surpassed anything that 5% can do for us with just a couple percentage points more. Now, for the final 5 years, the reason I spaced it out a little bit differently, I just want to show you how powerful these last 5 years will be in this example. We jumped 10, we saw the dramatic differences here, and if we just jump 5 more to the 25th year of this example, you will be amazed to see $5,861.76. If you were thinking something maybe more spectacular than that, if you're thinking it was going to double again or something like that, I'm very sorry to disappoint. But the differences in the rate of growth that we are seeing here in just 5 years is truly extraordinary. And let me break it down a little bit for you. When we last checked in, we were at $281 a net year of interest. Now we are at $400.32 in interest, over $120 more. Our compound interest is $327.02, which means we are ending this experiment with a total percentage return of 486.18%. Truly, truly outstanding. We just under 6x our investment in 25 years, just under 6,000 there. That's if you invest $1,000 into the S&P 500 using the past 25 years rate of return of 7.33% and did not add a single dime to it. You let interest add all of the dimes to it, and add a lot of dimes they did. They added interest added $4,861.76. Truly fascinating stuff. I hope you guys enjoyed.